Hi, I'm Larry Shover, Chief Investment Officer of SFG Alternatives, reporting to you from the CME Group in Chicago for our September Managed Futures Monthly Commentary. Last month, we spoke a little bit about an evolution of a crisis. What happens during times of stress, and why have managed futures, by and large, done well in the past during times of stress, during times of crisis? I really want to just dig down just a little bit deeper with that and talk about two terms that describe what happens during different market environments. This might be a good thing to remember with regards to maybe adding managed futures to a portfolio. One hand, we have what I call convergence. It's not something that I've coined, it's been around for a very long time, but that includes stocks, bonds, and actually some hedge funds, if not most hedge funds. On the other hand, we have what's called divergence or divergent trends. That would be managed futures and also some global macro hedge funds that are available to the market. Now, when it comes to convergence, this is how we define the world. When you look at all the investment universe, convergent strategies say that the world is mostly efficient. There will be short-term mispricings of stocks and bonds, but at the end of the day, everything is efficient. We profit from mispricings in the market. Assets have an intrinsic value. Now, an example of that would be the equity markets. We know that equities generally are bought and sold based on expected earnings, expected dividends, and growth rates. And if a stock is undervalued or overvalued, people buy and sell accordingly. And that's when you always hear a rotation from sectors to sectors where things are undervalued compared to being overvalued. That's classic convergence. And moving forward, we have divergence or divergent trends, where past patterns can predict what's going to happen in the future. Fundamental information in the market is incomplete. It's not efficient. Markets don't follow fundamentals, especially during times of stress. And that's something we can look back, look at your portfolio. You have a good company with good earnings and good everything, but in times of stress, it does not follow fundamentals. Markets, by and large, at the end of the day, and especially during times of crisis, are governed by behavioral bias, by fear, by panic, by all of these emotions. And obviously what we've talked about with divergence and divergent trends, managed futures encapsulates that entire thing, where they just are able to just do very, very well in times of crisis. Now, the bottom line, this is the takeaway for this month's video. The takeaway for convergent trends or convergence is that value can be estimated and we buy and sell accordingly. And obviously that works when the markets are trending higher, if they're really going nowhere. Fundamental valuations absolutely make sense, and history has shown that owning stocks and bonds in a portfolio has made money for people. However, on the other hand, there's divergence, where divergence believes that information in the market is incomplete, that markets are somewhat predictable during the times of crisis. Now, I can't guarantee what's going to happen in the future, and you don't want me to guarantee what's going to happen in the future. However, managed futures in the past have shown to work very, very well, especially during times of crisis. Academics will say that theoretically managed futures can earn a positive return in any market cycle. However, when we look at convergence versus divergence, you want to add managed futures, whoever it happens to be, because divergence and convergence, marrying them together, makes a lot of sense, and it just helps to decrease the left side of the probability distribution during times of crisis. Thank you very much. I look forward to talking to you next month as we dive deeper into the managed futures world. Again, I'm Larry Shover, CIO of SFG Alternatives, reporting to you from the CME Group in Chicago.